African International Bank, Bank PHB, Spring Bank, Sky Bank, Trump Bank, and Heritage Bank all collapsed in the last few years to the ground. Now, try calling 5 insurance companies that has gone extinct, not merged though, not rebranded, completely wiped out. I'm waiting. No, right? Now, most people would struggle with the second because you won't be able to give me a good amount of names, right? Why? Because banks fail loudly and frequently, while insurance companies die slowly and almost never. And it is not accidental, it is structural. Banks can collapse overnight, but insurance companies can remain solvent even after a massive disaster. A single bad decision can sink a bank, just like that. While an insurance company can survive thousands of bad events, yes, banks are seen as stronger institutions, but in the world, insurance companies actually contribute more to the economies than the banking system. Yet, banks are seen as stronger institutes. That belief is nothing but an illusion. Now, what I'm going to break down in this video is the false confidence people have in banks, expose the misunderstood strength of the insurance company, and help business owners, civil servants, investors, and professionals rethink risk, money, and protection, and shift you from short-term thinking to system-level intelligence. This is not anti-bank, trust, believe me, because no matter what I do, you're never going to turn away from the bank, neither will I. So this is not anti-bank. It's pro-understanding. Now, why do banks go out of business compared to insurance companies? Let's break it down deeply. Banks sells trust, insurance sells time. Banks promises access to money, while insurance promises future compensation. The moment trust disappears from the bank, people panic, rush, or calls. Insurance doesn't face a panic withdrawal problem. Never ever. You will never see that. Banks are always victims of human panic. Like banks collapse because of fear, not just losses. Exactly. Companies do not face mass emotional withdrawals. Here in insurance, claims are documented, investigated, and paid as quick as possible. No stampede. The reason is banks borrow short and lend long, which for me, if you think about it, technically is a dangerous game. And by law, they can lend money that comes back in a year's time, or even lend it all. But imagine a technical situation where they lend it all. Then imagine everyone come and ask for their money back. I'm sure that will never happen though. But this mismatch kills banks. Insurance companies collect premiums long before claims. Invest patiently, pay over time. Most importantly, for every 100,000 naira you give to an insurance company by law, they are to keep an extra 100,000 naira for reserve. So if everyone asks for their money back, that way they get to pay it back because the money is reserved. Another reason is one bad loan can kill a bank. Yes, I have seen it happen. Heritage Bank, for example. Now, when Heritage Bank was about to go out, even if I had 250k, I didn't get my money back. After all the write-up and the forms that we filled, both physically and online, nothing was paid. Probably they paid to some people. Maybe who they know and who did not know, who were lucky. I never got my back, and that money was not even mine. It was for a friend's rent. I had to pay money. That I did not plan for. It was not even funny at all. Like, it's so funny that when this bank was about to go down, there were stories that the staff of this Heritage Bank went to a particular politician's house to protest. And the man should bring the money. That is the one that's holding on the money. That is always coming to collect because they know, they are aware that this man has collected so much. So you see the bad side of banking. So insider loans, they give insider loans, oil and gas exposure, and FX speculations, whereby speculating is going to go on, speculating is going to go back. You can just get a bad trade, and you know a lot of things can happen. So one bad loan can kill a bank. It can also destroy a bank's balance sheet. Insurance companies spread risk across. What we do is thousands of policyholders, millions of them, multiple sector, multiple years. Not simple clients, like not one client. I come to the insurance company and say, because like, I don't care if you like, let your oil company or your business be worth over 100 billion. We will insure what we have to, and we will spread it across abroad where they can cater for that amount. It's not rocket science. So not one single client can close us down. Nobody. We transfer risk. Banks absorb it. Why insurance companies transfer the risk? Banks carry risks on their books. Insurance companies reinsure their own risk. Like I mentioned earlier, local insurer pass risk to global giants. Loss is shared across continents. Like that is how the insurance globe works all over the world. We share. So no way, in that way, we're not too shaken. Even if you hit us, we'll still stand. That's why I said multiple things can actually happen for it to be standing. So banks really have that luxury. Another reason is banks are highly leveraged and bombed. Yes, banks operate with thin capital buffer and massive leverage, while insurance firms are capital heavy, regulatory conservative. Everything is not conservative. Our risk is small. We are risk companies. You can imagine our specialty is risk. And because you carry too much risk on your back, one day you enter gutter. Normal human being mindset or mentality, that's how it's supposed to be. But because we are experts at risk, we are better people to handle that risk for you. And that's why we don't just go out of business. We know how to handle it. We have studied it. We have seen it. We know how to handle it. We know how to operate it. So we thrive in regulatory conservation and forced to keep reserve. Like I said earlier, for every 100 or for every 1,000 naira, you have an extra 1,000 naira reserve. That's because leverage magnifies failure. Now, people don't know that regulations actually punishes insurance companies' failure early. Insurance regulators step in early. Exactly, like you will not even last that long. You will not. You're out of it. Your license is gone. Like they will not even allow that bullshit. Like regulations come in to check your solvency margins, then they do a reserve check. Banks often look healthy until they suddenly aren't. Insurance claims are predictable, of course, certainty in an uncertain environment like Nigeria. So despite this disaster, premiums are priced for probability. When it comes to banks, it depends on human behavior. The market has to do with human behavior. So if people are panicking, if everybody is panicking, the market is going to tell. If everybody is happy and confident about the market, it's actually going to show. We all know what it means. Humans fluctuate. Our human behavior and intellect and whatever, our emotions fluctuate. Money and emotions never go hand in hand, which has to do with the market cycle. It is always much harder to predict. Banks are politically exposed in a way that you might not even see it. They fund government, finance election, carry policy risk. When politics shift, banks suffer. Insurance companies are politically boring. They go near there, and that's strength. Firms are built for bad news. Yes, I said it. Disasters are expected. Always. That's what we live for. We don't only enjoy the living. Like I said, we're a risk company. That's what we do. Our business is risk. So we're actually calculating for every kind of risk I think of. That is literally the business model of insurance. Why banks are built for stability. When instability comes, they panic. Compete on speed. Insurance compete on survival. Because when it comes to bank raise faster loans, bigger margins, risk bets, while insurance firms optimize for longevity, stability, and slow growth. So it's like a woman who lost all her goods in the market but did insurance. Let me say, when the goods got burnt, the goods were worth over 4 million naira. But when she did her insurance, the goods were worth about 3 million in her shop, and she got 3 million naira back, and that's a survival. Exactly. So insurance is a risk business, but banking often pretends they are not. But banks often assume this time is going to be different, but it never is. See, people trust banks with wealth, but ignore insurance for protection. Yet, forgetting that insurance is what protects that wealth. Yes, history shows banks collapse faster, insurance survive longer. So the real danger isn't lack of money, it's understanding where stability truly lives. Insurance is a financial shock absorber. We think in systems, not slogans. Understand why wealthy individuals and corporations diversify with insurance. I mean, as one of the strategies when it comes to business, because any intelligent person who owns a business worth millions or hundreds of millions of naira or even less that doesn't have insurance as a strategy, sorry, I don't think you're that smart. You're supposed to insure, hedge, and plan long term, because fear turns into clarity and ignorance turns into strategy. Banks fail because they are built on confidence. Insurance companies survive because they are built on probabilities. Confidence disappears fast. Probability doesn't care about emotions. Banks collapse in a wave. Insurance firms endure across generations. You remember the 2008 collapse? How many banks went down? The government had to come. The government had to come in to rescue them, right? A lot of them. How many insurance companies did you hear went down? How many?